online for the next few minutes. I know everyone has I'll make a start for one of the keeping stuff, which is important, mostly for people in the room. So there is a lunch afterwards. I believe that would be through that room. Unfortunately, not for those who have dialed in. That's just the nature of dialing in. There's no fire alarm planned again for people in the room. So if anything does go off, I believe maybe go through that door and that door. So just follow the Deborah will be very much in front, leading the room. Thanks to everyone for joining us today for this IUA event. For those who don't know me, I'm Joe Shore, Senior Market Services Executive here at the IUA. One of the committees I'm involved in is our property underwriting group and our property claims group. And obviously one of the big issues that we've been looking at recently is business interruption, post-COVID, looking at some of the wordings and the claims that are coming through there. Delighted to welcome two speakers from Sedgwick today, Joe Tobias and Cranston Watts, speak on BI claims in the current business environment and to question if insurers are paying out more than they should on BI claims. I'm sure insurers would like the answer to yes, they are. So I'll hand over without further ado to Joe and Cranston. Go through the talk.
Good afternoon. My name is Jo Supaya, and thank you all for joining us today. I head up the Forensic Advisory Services Division at Sedgwick, and there's my colleague Cranston Watts. He's a director with Sedgwick as well. I co-chair the Insurance Institute of London and Claims Committee, and Cranston is a Education Secretary at the LBIA as well. So today, we're going to just talk through some of the issues that we have been seeing in terms of the business interruption claims. Just after COVID, some of the issues that have become, that's come to light, or it's just the operations that we are dealing with and in this volatile market. So we're just going to go through some of the key issues and talk through. If you have any questions, please feel free to ask us at the end, or maybe if you want to talk to us whilst we go through some of the issues that we're going to discuss. So.
Thanks, Joe. So before we get into some of the issues arising, we thought we'd just touch very briefly on a sort of classical BI policy. The policy defines how the loss is measured and calculated, and this consists of three principal elements. The first is item 1A, which is loss of gross profit, loss of revenue. This is essentially calculated as the turnover that would have been achieved but for the insured event, less the turnover actually achieved in the loss period. A rate of gross profit is then applied to this loss of turnover, and it's important to note that that rate of gross profit will be defined by the policy and may well differ to that in a company's accounts. Item 1B is increased costs of working. These are extra costs incurred to avoid or to reduce the extent of any loss of revenue. This is the fun part of handling claims. Lots of examples of this. Classic ones would be outsourcing, subcontracting, or accelerating reinstatement works. And lastly, it's savings, which are often described in a policy simply as charges or expenses of a business which reduce or cease in consequence of an insured event. And in practical terms, they are calculated as the cost that would have been incurred by the business had the event not happened, less those costs actually incurred. Importantly for today's talk, you see that each one of those effectively requires a projection into the future. So it's a projection of turnover that would have been generated, the rate of gross profit or cost that would have been incurred but for the insured event. And what that means is that you're effectively standing at day one of a loss and projecting potentially 24 or 36 months into the future, depending on the maximum indemnity period, and trying to work out what turnover, what costs, what rate of gross profit would have been. So you get your projection of these items, you deduct your actual costs, revenue, etc., and that simple terms, that gives you your BI calculation. There's obviously a lot more to it, but in simple terms, that is it. What we're primarily focusing on today is really this projection into the future and some of the issues that have arisen that make it more difficult than it has been, as well as touching on some of the policy issues arising. The other key clause, the key clause within a BI policy that's relevant to today's talk and the current economic environment really is the other circumstances clause. And the policy gives the starting point for the calculation, which is the prior year periods to the loss. And then adjustments are made for circumstances arising in the loss period, such that the loss calculation, as practically and reasonably as possible, reflects what would have happened had the insured event not have happened. The clause, as I said a moment ago, the key clause here is the trends or variations or other circumstances clause. Different carriers will use different terminology, but it's typically trends, other circumstances, or variations clause. And this is a very, very powerful clause. It's a small clause, but it's very powerful. And this can be applied to turnover and the rate of gross profit. So the policy says you start with the 12 months immediately prior to the date of loss. You then use this clause and apply adjustments for other circumstances arising such that the calculation, as reasonably possible, reflects what the business would have achieved had the loss not have happened. In times of relative stability, economic stability, say, if you look at, say, 2000 to 2020, there was the financial crisis, but it was a period of broad economic stability. And basically applying a trend in those times was not easy, but it was often a lot more straightforward. You had a business that might be doing broadly the same turnover each year. There might be a slight positive trend, there might be a slight negative trend, but the calculation was somewhat more simple. Mm-hmm. You come into 2020, the pandemic and all these other circumstances arising, and this loss is then quite significantly more complicated. And there has been so much change, so many factors arising in just the last 2 or 3 years, that the calculation of a BI loss has become significantly more complicated. That's not to say it was easy pre-2020, but there's just a lot of factors that have arisen in a very short period of time that make it significantly more complicated. And as I touched upon earlier, the projection 24 or 36 months into the future is certainly more difficult than it was previously. So the aim of today's talk is really to look at these issues that have arisen. Again, they've mostly arisen in just the last 2 to 3 years. What are the impacts on BI losses? What are some implications for policies? And what are some of the potential solutions for handling BI losses in these times? And I'll now pass back to Joe, who's going to look at the first of these.
So we've just been talking about this trends clause that we use to calculate the expected revenue. So when we look at a business interruption loss, the first point of when we look at calculations, we are trying to project what the business would have done but for the loss. So we're trying to calculate or determine this expected revenue. Historically, we've always tend to look back, even the trends clause in the policy states that you look at the pre-loss 12 months. That's the general wording you find. But historically, we have looked at the base period as the pre-loss 12 months. But currently, with the volatile market that we are operating in, is it still relevant, the 12 months pre-loss? Does that represent what the business would have done going forward? Projecting the revenue for 24 months or 36 months ahead, is that still relevant? I mean, that's the key question we are trying to look at here. Can we base our calculations on 2020, 2021, 2022 revenue? I mean, the businesses have been through a number of issues here, including COVID. There have been other factors that's coming into play. So when we determine what that expected revenue is, should we be looking at other factors? What is that baseline expectancy level that we should be setting in calculating revenue? What is the new normal? I mean, we talk about this is the new normal, but what is our new normal now? How do we calculate this revenue? And that's the first question that we really need to address. If we look back at 2019 as a basis, are we looking too far behind? So it's about really understanding what we need to be looking at in terms of looking at these business interruption losses going forward. One of the other issues, I know we've been in sort of Brexit talk for quite a number of years, but we sort of decided to go for Brexit in 2016, and we got voted and came into play 2019. We spoke about how the insurance market needs to prepare for this, what sort of factors need to be taken into account when we look at policies, limits, what should the policy holders do, what should the brokers do. There was a lot of discussion, but what we are seeing in actual claims is that implication of Brexit and how that's impacting the claims. And we still see there's a little bit of gap between what's actually happening as a result of the Brexit versus what the policy responds to. I'm just going to share an example that I have. So I dealt with a claim for a builder's merchant. They had a loss back in sort of early 2020, so just as COVID started. And they were very much reliant on the EU market for their supplies, and even their sort of the builders that came in was very reliant on the EU market. Just after Brexit, they saw the cost increase. So the purchase cost of the products that they purchased for sale, the cost started to rise significantly as a result of the import duties, the sanctions in place, and so on. They had a loss early 2020. But if I was to look at the loss, looking at the historical gross profits that they were earning, was much higher than the profits that they would have just after Brexit, because their margins got really squeezed down. So really looking at the losses, the claim was submitted looking at the historical 12 months, but the actual margin was sort of not representing that. It was further sort of that specific in terms of construction. There was a further implication in terms of the labor market. So most of the construction industry, I think there was 95% of casual labor is heavily dependent on sort of EU labor. So soon after Brexit, we had, there was an impact in terms of the labor force because people started to return back to Europe, and there was a squeeze in the labor market as well. Again, the cost of labor increased. There was a specific impact in terms of the losses there. So when we dealt with that loss, the trends that were put in to calculate the claim or the projection based on historical results were no longer representative of what that business could do going forward. So again, these factors, I think, came to light when we actually did the claim. So looking at the policy had words of looking at pre-loss trends. Policy had gross, the values declared looking at historical trends, but the actual sort of loss was no longer representative of what happened historically. So again, these are factors that need to be brought to light or thought of when we take on risk. I mean, insurers taking on risk as well as policyholders when they're looking at insuring the risk. These are factors that need to be considered.
Another new factor that's come into play again in a large way in only the last 2 or 3 years has been inflation. Over the last 2 decades, so 2000 to 2020, inflation has typically ranged between 1% and 3%. Inflation in February 2023 was 10.4%. That's on a CPI measurement, up from 10.1 in January 2023. And high rates of inflation in the UK are expected to linger longer than other advanced economies. It's a mixture of energy costs, but also the significant labour shortages the UK is facing relative to other economies. The latest projections are that inflation will reduce to about 7 to 7.5% by the end of the year. And then by late 2024, early 2025, PwC are saying that they think it will be back in that sort of 1 to 3% band, although there is quite a strong caveat to that. Historically, of course, industries that are exposed to commodities will have experienced significant cost increases, fluctuations. But I think it's fair to say that the UK or the European economies have not experienced wholesale price increases at sort of 10, 15% in the last 20 years. And that is just another new factor that has crept in only the last, it's really the last year, if you think about the situation in Ukraine. One of the key impacts of inflation on a BI loss is on gross profit margin. The question arising there is, what gross profit margin would have a business have achieved during the loss period? To put numbers on it, I'm handling quite a large loss just now. This business, broadly speaking, had a margin of about 40% year on year prior to the loss. About a month before the loss, and the input costs went up by about 20%. And we can see during the loss period, those input costs have gone up by about 50%. We're then there having a debate with the management to the extent that they would have been able to maintain their margin during the loss period. A business is able to maintain margin by simplistically two ways, one of which is put up price. And anecdotally, as a team, we've seen quite a few businesses putting up prices. I'm sure as consumers, you've probably seen prices going up. The question then is, what is the extent of price elasticity? If you put prices up 10%, what happens to demand? That is something that needs to be considered. The other way businesses can deal with inflation is cutting costs. And again, anecdotally, we've seen quite a few businesses trying to cut costs and pinch costs where they can. I've seen hospitality groups changing their menu, removing low margin products, shrinking portion sizes. I've seen hotels moving towards staffless check-in. So you check in without having to speak to a member of staff. That's the kind of thing that probably would have happened at some point in the next 3 to 5 years, but inflation is accelerating that. The extent to which, one industry, if you look at the graph on screen, where there is usually an ability to pass on raw material input costs, is the food production industry. And the graph there on screen shows meat selling prices and raw material costs on a supply contract to supermarkets. And as you'll see there, they broadly track. So as costs go up, the price to the supermarket broadly goes up. Now you think that's perfect, that's great, they'll be able to absorb all the commodity price fluctuations. There are still gaps. There's often a time lag between the prices going up and the costs going up and the prices being passed on. And this is still, it's just another industry, even where at face value there is protection from inflation, there is still pressure on margin, and that needs to be considered in a BI calculation. Oh, sorry, I've jumped on early, sorry. Industrial action and strikes, that is another relatively new phenomenon, certainly in the UK. Again, that's not to say there has not been industrial action in the last 20 years, but I think it's fair to say there's been nothing on the scale of the last year for a long period of time. Putting numbers on that, the number of labour days lost to industrial action in 2022 was by far the highest it's ever been since 1989. Industrial action can have an exaggerated impact on certain sectors such as retail, restaurants, hospitality. I've got a couple of claims on the bill just now where businesses are doing quite well, and then you see the months of the train strikes and footfall and revenue just falls through the floor. And that's just another matter to consider in what is already quite a complicated environment. The availability of labour. There's been a marked shortage of labour in the UK in the past 2 to 3 years. As Joe mentioned, that is unquestionably, I think, partly linked to Brexit. In Q4, the number of businesses reporting to the ONS that they were experiencing what were termed as severe labour shortages was 14%. And there's currently 1.2 job vacancies in the UK as at December 2022. And that compares, if you look at the screen there, to an average of about 400 to 800,000. It's really quite stark, the extent of labour shortages in the UK. The impact on BI claims, if there is a shortage of labour, one thing we are seeing quite a lot of is that businesses are very, very concerned that if they are closed for a period of time and they lose staff, is their recovery upon reopening, beginning trading again, is that going to be significantly impact? There is just a greater incentive to maintain staff and keep staff happy during a prolonged BI closure period. And what we've seen is that, it has happened in the past, but more and more insurers are coming to us and saying, we're going to be shut for 6, 9, 12 months. Can we please pay some extra to our employees to keep them happy? Can we put them on events, etc.? It's basically a demand for increased costs of working. These will either be additional increased costs of working or increased costs of working. There may also be a willingness to make redundancies. I think pre-2020, if a business was going to be shut for a prolonged period, there may well be, businesses may well have let go quite a lot of the staff. I think now in the current environment, there is increasingly a fear that if a company lets go of staff, will they be able to rehire staff? Will they be able to rehire skilled staff? And therefore, there is definitely a reduced propensity to make redundancies during a prolonged closure period. In terms of policy issues here, I think one of the key things is, are your limits for additional increased costs of working sufficient? This is often a bit of a bolt-on to policies. A lot of these increased costs may well be deemed to be additional increased costs of working. And we are seeing quite a few cases where the limits are being exhausted. With these increased costs of working and reduced savings, the outcome for the BI claim is quite simple. It basically means the cost of the BI loss will go up. So if you had comparable losses pre-2000 and a loss now, it is likely that there probably would be, in terms of savings and increased costs, the bottom line gross loss would increase. Changes to working practices. There have been significant changes to labour practices with the explosion of hybrid working. I only need to look at the number of people dialing in to this call today. There has been some divergence. If you look at the press, there has been some divergence across different companies, with some people saying, everyone back to work, and others saying, 2-3 days in the office is fine. But it seems that hybrid working is here to stay. And in London, in the period September to December 2022, the ONS said that 28% of people working in London did a mix of working from home and their place of work, and 16% worked exclusively from their home. And those numbers are up by a factor of about 6 from 2019. So it's clear that there has been an explosion in hybrid working. There's lots and lots of impacts of hybrid working. The obvious one is commercial real estate, and that market has undoubtedly been impacted. But there are lots of smaller impacts as well. And there's been changes to, for example, the hospitality sector. An out-of-town suburban coffee shop or restaurant may have had a very poor trade during the week and done better at the weekend. In the era of hybrid working, they are probably doing a lot better during the week. And if you look at, say, a city centre restaurant or hospitality setting, they are likely doing worse during the week. Try and book a restaurant in the city on a Thursday and do the same thing on a Friday, and you'll probably get a very different response from the restaurateur. In terms of handling claims, the issues for us are, we would, pre-2020, we would typically look at a more suburban setting and think, well, that's probably quite a quiet place. If you were setting premiums or you're broking, you might think, more suburban place is quiet, city centre will be busy. I think those assumptions need to be changed. I think hybrid working is here to stay, and all those factors need to be considered.
I think the points that we have raised, we've come up with a lot of, probably you might think these are factors that you are already aware of. Brexit, in terms of hybrid working, in terms of having more sort of labour implications and so on. But what we are seeing is how that's impacting the business interruption losses. The losses that we look at is no longer just simply looking at historical values and a few other factors. It's just there are lots of factors that are coming into play. There's a lot of volatility when we look at the claims. There's longer reinstatement period. There's supply chain issues that we're looking at. There are labor costs. So the cost structure of a business is changing. The margins are changing. The revenues, in terms of inflation, that's changing. Are we passing that on to when we look at insuring those risks, are the policyholders sufficiently insuring? Are they getting the revenue values right? So these are the factors we're seeing in terms of the claims that we've been recently handling. Another good example and another key issue that we have seen is the currency volatility. So obviously there's been a huge volatility in terms of currency movement. Some of the claims that we are dealing with is under the master policy. So sometimes you might see the policy would have different currencies in which they're insured. So the local business might be operating in a different currency and the master policy would be insuring it in a different currency. I'm just going to share an example of a claim that we just recently settled, myself and my colleague Christian there, he was involved in this claim as well. So this was a loss that happened in Romania and they were using their sister plant in Russia to do some mitigation. So they were using Russian plant to help them get some of their production back in place. The policy was on the loss was considered under the master policy and that the policy was in euros. Sometimes you will find the policies either very explicit about the rate of exchange that you should be using. So sometimes it might state it's at the date of loss, date of settlement, date of purchase, but some policies are quite silent. In this claim scenario that we were dealing with, this loss happened sometime end of 2021. So the mitigation was carrying on in Russia, but then the invasion happened early 2022, February 2022. So there was a massive drop in the rubles and the exchange rate dropped, but then it spiked soon after because of the fuel price increase, the rubles increased. So it really appreciated against the euro. The claim was settled at sometime just after the exchange rate appreciated. So the claim was settled after sort of mid-June 2022 at the point at which the ruble increased almost 48% shift from how the currency devalued and then appreciated in value. So when the claim was settled, the insurers were paying almost quite a few million euros more than what the value was because it was set, the exchange rate was used at the date of settlement. So there was a massive swing from the date at which the loss actually happened to when the claim was settled, and the volatility had a huge part in terms of how the claim was settled. So again, we might not see policies that might have be explicit about the exchange rate that we use, but this is a good example of what we need to be considering. So in terms of another factor that should be considered in terms of looking at business interruption losses.
Longer reinstatement periods. Since COVID-19, this has been another big change that has materially impacted BI losses, and that's been the building shortages and cost increases. That's I think been very high profile in 2021 and 2022. And if you look at the data, I don't think that's going to go away anytime in the near future. I'm putting some numbers on it. The latest ONS building material and component statistics for 2022. These show that the average annual building materials prices in 2022 were 54.4% higher than 2015 and 25.1% higher than only 2021. So, there have been undoubtedly huge increases in these prices. There's also been a significant increase in lead times on many building materials, which in many cases are now 2 to 3 times that pre-pandemic levels. And the DBS recently released some key points in this. Some of the highlights were steel joists. Pre-pandemic, the lead time was typically 3 to 5 months. That's now 9 to 12. Precast concrete, 6 to 8 weeks pre-pandemic, now 14 to 18 weeks. And roofing membrane, 3 to 6 months, and that's now gone to almost a year. So it's clear that lead times have increased significantly. I was chatting to a senior adjuster a couple of weeks back about this, and they were saying, as a rule of thumb, pre-pandemic, if they had a steel portal frame building, pretty basic building really. If that was completely damaged and needed to be rebuilt, they would assume broadly a 9 to 12 month rebuild time. And then I was saying that in the current environment, that is at a minimum for reserving purposes, they are assuming 18 to 24 months plus the customer build up. And obviously, if you're shut for 24 months, your customer build up time is going to be longer and much more difficult than it would be if you're only shut for 12 months. These increasing costs also lead to potential underinsurance on the buildings policy, and that can lead to difficulties with the reinstatement. And again, that's obviously something for underwriters to be very cognizant of. When you're setting something insured, what is that based upon? Adding to the supply chain and material shortages, the result just generally is significantly prolonged reinstatement periods and indemnity periods in the current environment. Pre-pandemic, I think we would say that as a rule of thumb, 12 months was basically never enough. And I think it's fair to say that, in the current market, the current environment, even 24 months is often not enough. By the time you've got through planning, etc., and you've tried to get materials with a long lead time, 24 months is often not enough. So quite frankly, the impact of all this is just longer indemnity periods. And again, from a policy perspective, is 24 months enough? Possibly. Is 12 enough? Almost certainly not.
Another common issue that we are seeing now is just looking at fraud and insolvency risk. So obviously the temptation to sort of have some fraudulent claims has increased following the pandemic. Some of the interesting statistics that you would see there is 40% of crime was related to fraud in 2021. COVID-19 related fraud was 350 billion, and bounce back loans were sort of issued was 47 billion, of which 17 billion was never recovered. So the point that we are seeing here is like when you take on, again, looking at risks, and when you take on risks, that's something that we just need to be aware of in terms of the when you take on policies and looking at the level of controls or measures in place, and similarly a policyholder looking at their own business, looking at the risk of fraud and so on. Another issue to be mindful of is, given that we're all moving into a hybrid working structure, there's a lot more reliance on technology. There's a lot more information shared on technology, and platforms are used to share information. There's been an increase in cybercrime. There's a tendency to come into that as well. So again, looking at other policies in terms of cyber policies and so on, are we looking at the right limits? Are we carrying the right level of risk? Are we ensuring the right level of risk? Again, that's another issue that's come to light. There's been an increased level of insolvency. I think in just after COVID, almost 50% of the SMEs were shut down. So they were either bankrupt or they shut down. So again, the risk of insolvency means there's more and more policyholders are looking for efficient, sort of speedy interim payments and cash flows to be supported. So I know the Enterprise Act came into play in 2015, but that means there's going to be more risk of perhaps we need to be aware that there's more risk in terms of that coming to bite us in the back in terms of getting the interim payments flowing, cash flow support. And that's something that we have seen. There's more pressure to get the cash flow going in terms of when we look at businesses and paying interim payments. So just wanted to I think we need to move the slide. Okay. I think what we wanted to do is in this slide, just really recap these issues and how that impacts each of the key areas we look in a business interruption claim. So gross profit, when we spoke a lot about gross profit and the margins. Are the margins, historical margins, reflective of the margins that we are going to see looking ahead or looking forward? Are the margins correctly insured? Are they sufficient? Are they too low, too high? Have there been other impacts such as Brexit, tax imports, or extra import costs? Are the currency issues considered? And are you ensuring the right level of gross profit margin? And similarly, insurers are they underwriting the right level of risk that the business poses? Increased costs. We spoke a lot. We have seen in terms of the claims that we have handled, we've seen issues in terms of supply chain. There's longer reinstatement period. There's a lot more cost in terms of reinstating in terms of labor costs. We spoke about where businesses no longer want to let go of some of the labor. Back in the days, it was all about retaining skilled staff, but now it's more about retaining staff in general. Are we getting the right level of increased cost of working and additional increased cost of working cover in there? Have we got the right indemnity period in there because of reinstatement is taking longer? Should we be looking at longer indemnity periods? Savings. Again, savings is something historically we would look at savings, looking at historical overhead costs. We will compare that to actuals and say what that level of savings could be when there is a business that's shut down because of an insured event. But is that the right benchmark going forward? I mean, historical costs, do they represent, especially energy costs? We have looked at energy costs rising really. So looking at those kind of costs, are we using the right level of benchmark in terms of calculating savings when we deal with an business interruption loss? Value at risk. Again, value at risk, we spoke about the right level of risk being taken into account. So when we look at the margins, when we look at the loss of revenue basis, looking at the margin that you should be using in terms of calculating what the business could have as potential risk going forward. Are the businesses looking at what the risk would be if they had an insured event at the last day of their policy period? So looking forward 24, 36 months ahead. Some of the examples that we shared earlier was some of the issues are more specific to industry. So for example, the hospitality industry, for example, they use a lot of agency staff or casual staff. And following Brexit, the cost of that's increased. So have they got the right level of overheads sort of insured, or when we look at losses, are we looking at that level of overheads that's no longer variable? It's going to stay fixed. Similarly, I spoke about the construction industry and the issues that they had in terms of the following Brexit. So industry-specific issues have come to light because the market is so volatile and the issues are very forever changing. So the issues that we are seeing is also more severe in some industries as opposed to another.
And I think just summing this up, giving some potential solutions here to these issues. I think it's important to say that there is no silver bullet here. There is no easy way of getting through this. I think the point of this talk has been there's been a huge number of issues that have arisen in only the space of sort of 2 or 3 years. There's some implications on policy, but also implications on handling claims. From a claims handling perspective, here's just some sort of, I guess, some advices or solutions we've got for handling claims in this environment. I think the first point here is probably the most important in many ways is collaboration. I think if all sides accept that there are a huge number of background factors affecting any business in the current environment, I think if everyone accepts that, it does make the claims process easier. If everyone retreats into their trenches and just doesn't accept that these factors are out there, it is going to make for a more difficult and a more combative policy process, which is not necessarily a bad thing, but it may not result in a great outcome for everyone. The second point there, which Joe touched upon, is data. As Joe touched upon, prior year data may frankly be of limited or almost no use. So the importance of third-party data is increasingly important. It has always been important, that goes without saying, but instead of relying on prior year data, you may have to look at third-party industry data or sector data to guide what turnover would have been, what cost would have been had the insured event not occurred. There's a whole multitude of data out there, depending on the sector, depending on the industry that the business operates in. Some of the more common ones, SDR data for hotel and hospitality claims, SMMT data for the motor trade, or the Peach tracker for hospitality. They're quite common and readily available. The ONS as well also has a huge wealth of statistics. The only caveat there is that they tend to have a bit of delay on them coming out. So they can often, and the latest data can often be 6 or 9 months prior to the loss event.
And I think we spoke a lot about the industry-specific issues as well. So we have to consider every claim and take a claim on its own merits. So that's how we have sort of recently seen the claims. So it's not all issues are applicable to one industry, and it is not specific to what's applicable to one is not applicable to another. So again, we need to be looking at claims on its own merits. So for example, agricultural poultry markets, I think 20% of UK market is reliant on exports, of which 70% is exported into the EU, but they have been significantly impacted because of the Brexit and the paperwork involved and the tax implications and so on. And as I mentioned, in terms of hospitality, I think there's a significant shortfall. Nearly 330,000 workers in the hospitality sector are from EU origin. So again, they have seen a significant change in terms of the cost structure. So it's no longer the traditional way of looking at how the overhead costs are structured. If you look at hybrid working, rent cost was a significant overhead in the past, but is it a significant overhead going forward? Maybe not. And is that something that is that a fixed cost anymore, or is that variable? How are we looking at all this in terms of claims? Importance of a good policy cover, and I think that is key here. I mean, there's a lot, the policies are quite clear, but sometimes can be quite silent on some issues, and it is very important for the policyholder to understand what risks they are insuring. They, instead of taking last year's values and just reinsuring it, looking at old limits and just rolling that forward is no longer safe, I'd say. And similarly, insurers looking at the risks that they are taking on, just making sense checking that the correct level of tests are carried forward in terms of testing those limits, looking at the cover, looking at what risks they are taking on. So policy cover is absolutely key in terms of having that understanding what risks are being transferred. And yeah, so we're now just opening to sort of questions. Any questions? Feel free to ask. Yeah.
Yeah, it's on third-party data. I've got a couple of claims now whereby the use of third-party data was beneficial, however, the policyholder kind of came to a bit of a stink about using it. Obviously, their argument is it doesn't go into saying the policy you can use this and so on. So whilst it's useful, what in that situation would you do if there's kind of pushback to that?
So I guess for the audience, online audience, the question was to do with third-party data, using third-party data in claims. I think that's I think it's as I said, it's very, very important in the current environment. The question was, what do you do if the policyholder rejects the use of that? I think the policy it says you can the other circumstance clause says you can make adjustments and allowances for trends or circumstances arising that would have impacted the business. I think therefore it's entirely reasonable to use industry data. The caveat to that would be that industry data is not perfect, will not give you a perfect answer for every scenario, but it will at least inform the loss calculation. I did quite a large loss recently, and we had a similar issue come up. The policyholder rejected our third-party data, but we made the point that we accept it is not perfect, but we did some correlation analysis, and we can see that the business's performance did correlate quite well. There was quite a tight correlation between their performance and the sector performance and pre-loss. And we said, well, why would that correlation not continue during the loss period? We're not going to place 100% reliance on this, but it will at least inform our calculation of a loss.
Any other questions?
I think there is a question that's coming on the line. I don't know if you can read that.
We can just I think it's just oh yeah, it's sorry, I think it didn't refresh.
I wouldn't read it out at all, but it's quite.
Yeah, no, that's fine.
There's a big issue around someone's insured when placing the policy, and the insured has to forecast a long way ahead. It's easy to underestimate both the period needed and the values. MD reinstatement and BI. There's even more need for the estimated GP basis being properly used. Brokers cannot rely on this 133% limit as it doesn't change the sum insured. That's a very helpful point.
Yeah, I think it's so it's a statement rather than a question, which I think is absolutely key, because we have seen claims where there's been a massive increase in terms of property damage, reinstatement costs. As I mentioned, there's a massive increase in steel, massive increase in sort of some of the other costs that where we have had claims. We just couldn't rely on that declaration limit. It was far exceeding that. So again, it is very important to make sure that we get those limits right, including PD reinstatement costs.
I think as well, to Joe's point as well, that it's you've got to look at a potential loss happening on the last day of policy cover, and if you've got 36-month maximum indemnity period, you are effectively able to look almost 4 years in advance of the policy inception period. So you've got to be factoring that into when you're setting the sums insured.
I think there is another question on, I don't know if you can see on your screen, case following that.
Yeah, I'm not too sure what the question sort of, it's talking, they're talking about the Orient Express case law and the decision on that. Obviously, so just for the benefit of those in the room, the question is, what is the case law if there is any following a NatCat loss for a hotel, for example? Would the BI be adjusted if just the hotel had not suffered the loss, assuming other hotels were affected, then the demand for the hotel would have increased? Or is it commonly accepted that the BI is adjusted on the basis of had the NatCat not affected the hotels in the area? And I think this is where we had the Orient Express case law that came about. And but following that, we have seen the COVID implication, where if there was the originating cause was used, if the originating cause is the reason for a loss to happen, I think we cannot apply the same cause to predict trends, and that's what the ruling on COVID was, which was conflicting to what the Orient Express case law was.
So basically overruled it.
Yeah, just to confirm one question on there, there is a recording of this that will go around after, so that can be shared with others. I do have one other question actually, which is about clients' understanding of BI coverage. Do you think that that's increased following the pandemic? We've seen a number of examples with other classes of business where there's been a lot of claims, which is not necessarily good for insurers, but clients' understanding of the way that the policy works has improved. That's been kind of a soft benefit. But I wonder, particularly with BI, given that there's been so much core activity and I guess conflicting messages about what BI cover should and shouldn't do. I was wondering what your view on clients' experience of that. is from your interactions.
So the question was, I think effectively, you know, there's been loads of claims for BI. You know, has the client knowledge increased? I think it probably, Joe, I would say it definitely has. There's been, I don't know how many BI cases there are in a normal year prior to 2020, but from 2020 on, there's been an absolute explosion of them. A lot of these losses will have inner sublimits, or you know, inner indemnity periods, say 3 months. You might have losses, you know, smallish losses where you're showing that the policyholder that they're underinsured, they've never considered that before, and therefore they're going away and checking their sums insured, checking that they are set correctly. I think that the simple fact that just there has been so many claims compared to a normal period, people will start to have a better understanding than they would otherwise of BI, and I think that probably is only a good thing for the market. I think that's definitely been a benefit of COVID, if that's the right word.
I mean, it also depends on the business we're talking about at the level. So the SMEs, obviously, their knowledge is quite limited in the sense that we have seen a number of claims we dealt with. They believe that if they're insured, everything is covered. So they just don't understand what the BI policy does, whether it's damage trigger, should be damage trigger, non-damage impact should be also considered. But on the obviously the larger corporates, they fully understand and they understand what BI is as a basic sort of basis. But what COVID has done is thrown a lot of issues into the mix, and that's created more awareness of what BI losses are and what is covered. Maybe that awareness is sort of a little bit better now than what it was, because traditionally we were just looking at damage trigger, a few factors that influence the claim, but now there's a lot more factors that influence. So definitely policyholders are a lot more aware of what that risk is.
I think people may not have heard, there was a question, is the session going to be recorded? The answer is yes, it is, and it will be available for wider circulation.
Are there any more questions online?
No, nothing comes through.
I need to refresh.
No.
Any more in the room?
So do you think that, it's talking about a maximum indemnity period, do you think that the insurance companies will kind of extend it 3 years and 12 months might go now, or look at that going forward, indemnity periods?
We've never had 12 months. I mean, we hardly see policies with 12 months. I mean, that's even pre-COVID, we've hardly seen policies with 12 months. The general rule, there was a study carried out by AMIC, I believe, and the general average is about 18 months, we would see as a minimum. If at all, if we are looking at what this has done is, I guess, almost creates that level of consciousness to see if that's sufficient. We're looking at indemnity period going into 24 months to 36 months, or even looking at basis of the American wording, because some of the policies now have the option to select to go under gross earnings or gross profit basis. So if it's under the American wording or the gross earnings wording, there's no limit to indemnity period.
Thank you very much.
Good question, just for clarification. For the claims you have been dealing with, does the policy like have an average clause in it? So like they would be held to what they have declared, or not really?
So the question was, do policies contain the average clause? I think it is a mix. I think there is definitely a move in the market towards declaration linked where underinsurance doesn't apply, but there are still, I wouldn't put a percentage on it, but it'd be a significant percentage of policies would have an underinsurance clause in there, so average would apply. I think it's possibly there's a trend of seeing, again, some have like a limit. So if you're 85% or above adequate, your average won't apply. But if you're below that, it will apply. I don't know whether that's a new thing, but I'd say generally that's creeping in. But there's certainly averages is out there in a lot of policies.
Yeah, carry on.
A specific question from there in terms of the labor cost. like from the declarations you have seen, like obviously depends on the industry, depends on the partial loss, full loss. What do the clients generally declare as fixed versus variable in terms of labor costs? Do you see it's quite accurate? Like obviously today is very difficult, but my question is coming from that often what I have seen, and my space is different internationally. That they often are very positive about what they can, like, you know, say, which often that's like an issue for us. We don't, it doesn't seem very realistic in a lot of cases.
Yeah.
Because as you said, they will not prior a lot of stuff, especially.
Yeah. So the question is labor cost, whether we see labor cost being considered as fixed or variable. What do we see in terms of claims? And what our view on that is.
And also the declarations, like what's like if
and
you
how
if you analyze that, what's actually versus what they declare versus the reality.
and what we see in policies as what they declare versus what it is in reality. So as a rule of thumb, what we say is labor costs, you don't want to insure that as variable, or you don't call it uninsured working expense, because the labor cost largely is fixed. Yeah, there might be certain businesses that might be heavily dependent on agency labor or zero contract labor, and they can potentially vary. But given we've just spoken about the volatility and the cost of labor and so on, we would say that labor cost is sort of what we see is it's fixed. If you do declare it as variable, we have seen, as you say, especially in the international markets, they would say, yeah, but we would be able to save a certain element of cost if we do have an insured event. Therefore, we'd like to declare it variable. But certainly it depends on the loss, so whether it's a partial loss or a full loss, because what we would tell or advise the policyholders is to always assume that they can be faced with a partial loss scenario. So even a variable, sort of a temporary labor or zero contracted labor can no longer be variable. Even if it's a partial loss, the likelihood is that can be a fixed cost. If the loss is only 1 week, are you going to turn around your labor force and say that, yeah, you're going to not have them? So a partial loss scenario means labor can always be fixed. So on that basis, our advice would be to make sure labor is sort of not considered as an uninsured working expense. Unless you you're absolutely sure and you have agency staff that you think you can dismiss even if you had a day's loss.
Are you seeing more insurance companies wanting to buy reinsurance to cover business interruption? And then on the other side of that, is there more like a reinsurers not wanting to cover BI or excluding it?
I mean, to be honest, we are not visible to, sorry, the question is, are we seeing there's more reinsurance, purchase of reinsurance, activity for BI in the market? I mean, we don't directly see that trend, or we don't see whether there is a reinsurance, there is an increase. Perhaps that's more brokers would be closer to that kind of detail to advise or so on. But we have generally, in terms of the claims that we handle, it's largely for insurers. We do see there's a higher captive level. So self-insurance is slightly higher for the bigger corporates because they are trying to keep the risk in-house. But in terms of reinsurance, it is, if it is, I mean, I think if we have very excess we have seen reinsurance claims that have only come to us following a Nat Cat event. So we've seen following sort of the Portrick and losses and the floods and so on, but on significant Nat Cat, we don't come across reinsurance. Well, from our sort of experience in terms of the claims.
Okay, well, I know we're now at 2 o'clock, so just wanted to make sure we leave enough time to say a big thank you to Joan Cranston for coming in and it's a very informative presentation and answering all of our questions. For those in the room, just a reminder that there is some lunch afterwards, so please take part in that. Thanks to everyone who dialed in. I'll start closing the room. Thank you, Joan Cranston, for the usual way.